Today in Stocks in Translation, we're going to take a look at how the Dow is actually calculated. Now, the Dow was born all the way back in 1896, nearly 130 years ago, before computers, before calculators, so this index of 30 stocks had to be easy to calculate. And for sakes of simplicity, only the stock price is used. So the higher the stock price, the greater the weight in the index. And almost every other index, by the way, like the S&P and the NASDAQ, they use a company's market capitalization, but that requires a lot more paperwork and more calculations. So here's the full method. Basically, you sum the prices of all 30 stocks in the index, and then you divide it by a number called the Dow divider, which corrects for splits and changes in the components of the stocks. So anytime a stock has a stock split in the index, or when one stock is swapped out for another one, that Dow divisor will change. Now, here's a list of the 4 top stocks by price. Goldman Sachs is right at the top with $723.65 as of the close yesterday. Microsoft is number 2, Caterpillar is number 3, Home Depot is number 4. Now, United Health has a stock price of about $267 today, but before, just a few months ago, it topped out at about $600. So it actually would have been number 2 in this list had it not seen such a big slide. And I went in and I calculated what the Dow would look like with different configurations here. So the orange line right here, which terminates last, that is the actual Dow. And then when you take out United Health in yellow, you have that line up here. And then I also took out Salesforce, Merck, and then Apple, because those were some of the biggest losers this year by percentage terms. And what you end up with is a materially higher Dow price without these big drags in it. And some of them can be actually quite big. And I also did another calculation here. I took the Dow price weighted, that's the normal price weighting in white here, and then I also calculated it by market cap starting at the beginning of the year. And when you do it by market cap, and I'm just going to kind of trace this out here, we actually saw a lot more volatility by the lows. And again, this just includes all 30 stocks. I'm not taking out United Health or any of them. I'm just doing a different alternate calculation. So more volatility with the market cap weight version that we saw this year. Now, to sum up all the results, here's the market cap weighted 2025 year-to-date return. That came in at 7.3%. The actual price weighted number that everybody uses is 5.4%. And then the Dow minus United Health, that came in all the way up to 9.3%. And then you can take out Salesforce and Merck, and the numbers keep going up. And by the time you take out Apple, we have a Dow that's up 12.4%. And that's more than double the actual return of 5% and change. So something to think about here. There's no guarantee that the Dow will always be calculated like this, but after 130 years, maybe they're just not going to change. Stocks are back, and the speculative pulse that we're seeing today looks a lot like the afterglow of 2021. It's not just price action, it's also pressure on management. And on today's Stocks in Translation, we're going to show you the heat, define the phenomenon, and then test it with Open Door. Now, here behind me is a heat map of today's price action in our meme stock basket that we first created in 2021 with a few updates. We've also seen many of these stocks perk up over the last few months, and there are lots of familiar names here, so let's try to spell out what makes a meme stock. And here we wanted to find the vibe without getting too dogmatic, because there are lots of exceptions. But most meme stocks are consumer facing, or at least a familiar name. And when they first appear on traders' radars, they tend to be smaller companies with lower share prices. It also helps if traders are betting against them, so high short interest is another box check, maybe 15% if you're keeping score at home. And the most important criteria probably is heavy retail attention with a rip-roaring good story. Now, here we're looking at a chart of an index of highly shorted stocks from UBS. They're not all meme stocks, but it's a good proxy. And you can see that we recently hit the highest levels since early 2022. Now, we're going to want to watch how high this index climbs from here. But first, let's get philosophical for a minute. Why have meme stocks captured the attention of younger generations? Ed Elson, co-host of the Professor G Markets podcast, lays it out. His frame is very simple. The old menu feels closed, indexes are expensive, housing is unaffordable, and many of the most exciting companies, they stay private for very long times. He says we are locked out of the upside. So what do? We invent our own asset classes, crypto, meme stocks, anything that offers a chance at returns that we cannot access through traditional paths. Now, let's take a look of a case study here, and we're going to go to Open Door. Now, look at the year-to-date whipsaw from pennies to mid-single digits. It was down 99% from its 2021 highs, and now it's up multiple hundreds of percents off of its June lows, up nearly 40% today alone. That checks off a few of our boxes. It also helps explain why it's catching major retail attention. And now here's Anthony Pompliano with an interesting take. Pomp says the people calling Open a meme stock don't understand what's happening. Retail investors are now having a hive mind, working together to identify opportunities, take financial positions, and advocate for improvements at target companies. He goes on to say, it's like decentralized hedge funds with individual capital and collective intelligence. Product ideas are surfaced to executives and change is happening. He wraps up saying, the power of the crowd cannot be underestimated. Now it's scoreboard time. Let's measure what retail has advocated for at Open Door and match it with what has actually happened here. Now first, investors got the CEO switched out for an interim lead from product and tech. Check. They're also getting a renewed focus on AI, so check there too. As to the balance sheet, we'll have to watch future earnings releases to check that box, but bottom line, the executives are engaging publicly, which is not how things used to play out in the old regime. So let's zoom out here and look at the new playbook. Investors are organizing online to surface ideas. They accumulate shares, drawing the attention of leadership. Then they apply public pressure and they turn the screws. And if all goes well, not only do the execs listen, but they implement change. We saw some of this play out at GameStop and AMC, but to be fair, these two stocks have not become anything close to the poster children for turnarounds. So what's next for meme stocks, or should we say stocks that capture retail imaginations? First, we're going to need to keep tabs on that speculative fever, but you need more than momentum fuel. So does the C-suite actually respond to retail pressures, or do they just give lip service? Because at the end of the day, we want to know if we're all looking at a new activist force or just fuel for short squeezes. Index is sitting near record highs, even the small cap Russell 2000. The S&P 500 alone has added $16 trillion in market cap since the April lows, and meanwhile, the Fed is cutting again. And earnings season is about to start. But one of the biggest supports for stocks is fading right now, the stock buyback bid. And that's what we're digging into on today's Stocks in Translation. First, a quick definition. A stock buyback or repurchase is when a company uses cash to buy its own shares in the open market. Fewer shares can lift earnings per share and also support the stock price. And it can also help offset any compensation paid to employees in stock. The buyback is a legal, common tool, but it does not guarantee gains. The first chart that we're going to look at, courtesy JP Morgan, shows how stock buyback announcements have been tracking this year in white versus the 3-year average in green. Notice how 2025 climbs faster and higher. It's only September and we're already closing in on $1 trillion, which happens to be the end of year average. Also important, these are only announcements, not actual buyback executions, which we're going to take a look at next. This next chart by UBS shows the rolling 5-day buyback executions for 2025 in billions of dollars. Notice the rhythm. There are 4 separate waves per year, which coincide with each of the 4 earnings seasons. We're going to get to exactly why this is in a minute. Meanwhile, the dotted line shows where we are right now, and just to the right of it is an estimate for the rest of the year. Then if you look just to the left of the dotted line, you're going to notice how buybacks have recently dropped off quite steeply. This is because we are now in the buyback blackout window. This is a quiet period before earnings season when many companies pause share buybacks. They do this to avoid trading while they hold earnings results that are not public just yet. Some companies keep a small autopilot running, which is perfectly legal, but overall buyback demand, it drops noticeably. In this next chart from Goldman Sachs, we're going to zoom in on the current blackout window, which tracks mid-August through mid-October. The vertical axis tracks how many companies in the S&P 500 are in the window right now. The higher the number, the fewer the buybacks. And you can tell from the dotted line showing where we are right now that we're getting close to the peak, which extends into mid-October. This means the so-called buyback bid is shrinking, but should start building again as earnings results hit the tape and companies exit the window. The timing matters because September is historically the weakest month of the year. This chart shows the median gain or loss for each month in the year in the S&P 500 going all the way back to 1990. You're going to notice that only September tends to be negative. And remember, that's right about when the blackout window widens, which is right now. And although October is a good month for stocks on average, it's a month when historically we've seen a lot of stock market crashes and when volatility tends to spike. So just to recap, we are at record highs right now, the Fed is easing, we've got earnings ahead, but the buyback safety net is partially pulled back until results start rolling in. It just means a bit less cushion and bigger day-to-day swings. Here's what to watch out for next. Remember that the buyback blackouts, they peak in mid-October, then they lift. Watch out for the buyback bid to return as earnings season shifts into high gear. Then, as results roll in, you got to pay attention to companies updating their share repurchase plans. And also watch out for spikes in the VIX Volatility Index, which tends to get bigger into September and October. A higher VIX usually means weakness in stocks. And also, you might keep an eye on long-term government rates. A big jump, they can take bites out of stocks and kind of hit them harder when buybacks are light. So the bottom line is, for the next few weeks, the market's biggest consistent buyer is mostly on the sidelines. So a little caution is warranted as we celebrate all these record highs. On today's Stocks in Translation, we are going to break down the 50-day moving average. Let's start with a quick definition. Here we go. In technical analysis, it's the average of the last 50 closing prices. It moves a little each day as new data comes in and old data drops out. And traders, they treat it as potential support or resistance. And when everyone can see the same line, it starts to act kind of like an electric fence. You can test it, but if price starts living on the wrong side of that fence, people pay attention. And now a quick example. This is going to be the S&P 500, and this goes back to the beginning of the year. I'm going to throw on the 50-day moving average here. You can see that has been added in blue, and it's been in play over the last few weeks, especially last week and the last two Fridays, like I was saying. But it's not only the S&P 500 where prices managed to stay above this line, it's also the Philly Semiconductor Index, the SOX as it's known, XLK, the Technology Select Spider Fund, and NVIDIA, the kahuna of the AI trade itself. Now, Kenny Polcari and I were watching the S&P 500 near its 50-day during Yahoo Finance's Invest Day. Kenny spends a lot of time talking about these things on his Trader Talk podcast on Yahoo Finance, and he was telling us why you want to watch the price action when it gets close to this average.
What's going to be important in that is, does it hold or does it fail? If it fails, here's what typically happens. You get the algos that will kick in because we've had a technical failure on the chart, and then you'll get the algos that just operate based on a mathematical formula that will see that there's a failure and they'll go into sell mode, which will end up putting more pressure on the stock.
I love that because that's exactly what happened early Friday. The algos sold hard as the fences seemed to break and scared off those weaker hands. But by the end of the day, the pros stepped in and closed all the key markets above their averages, restoring those protective fences. Now, here are the ways the pros are using the 50-day moving average right here. First, they treat the average as potential support or resistance. Potential. If price has been riding above it, that line is often the first place where buyers step in. And if we've fallen below that line, the same line can turn into a ceiling. Next, watch how price and volume react intraday when the level is hit. Do you see a quick reaction off of it, or does price cut through it like a hot knife through butter? Then, is volume confirming or denying? All of these are clues, and the pros are also going to gauge the slope of the average. Is the 50-day tilting higher, rolling over, or just flattening out? A rising 50-day with the price above it is a very different animal from a flat or a falling 50-day that's being poked from below. Next, they use it with other signals, especially the 200-day or other moving average timeframes. You might have heard of the golden cross or the death cross. That's when the 50-day crosses above or below the 200. And then finally, there's the nerdy side. A lot of other indicators are built around these tools, the moving averages. For example, you can measure how far price is trading above or below the average, which helps tell you if the market is getting overbought or oversold. All of this now is just scratching the surface. What to watch next? First, does support turn into resistance? If key stocks and indices start trading below their 50-day, which seems to turn into a ceiling, that is a big tell that markets are reversing lower. Second, watch those slopes. You want to see a rising line that keeps catching a lot of buyers, not a flattening line that cannot contain price. Then, are those dips getting bought with volume, or is participation, aka volume, drying up? And finally, how many stocks are still above their own 50-day? If the majority of S&P names are holding that line, the fence is still doing its job. But if that number starts falling, the story might be changing. So here's the bottom line for investors. The 50-day is a very simple tool with a lot of nuanced uses. When lots of big stocks and indices manage to hold it when it's tested, it's a sign that the pros are still defending the trend. And when they step back and let price live on the wrong side of that fence, that's when the story tends to start a new chapter. Markets have been unusually volatile recently, as unpredictable and erratic as the weather itself. And when the sky flips fast, you check the weather forecast. And in markets, that forecast is the VIX, which is exactly what we're breaking down on today's Stocks in Translation, along with options expiration, which is adding another dimension of odd wonkiness to market behavior. First, let's dig into the VIX, also called the SIBO Volatility Index. This is our main weather gauge for the market, and it's calculated on options that trade on the S&P 500 about 30 days out. Now, most retail investors operate on a much shorter time frame than that in the options market, so the VIX is more a measure of how much protection big money on Wall Street is buying. As Interactive Brokers Steve Sosnick likes to say, don't call the VIX a fear gauge. The VIX is not necessarily based on emotions. And when these big investors rush to buy protection, they're seeing some weather patterns that might not be visible on the horizon. And when they buy en masse, the VIX spikes, just like a storm warning might light up your weather app. There's also a seasonal weather pattern to the VIX. It tends to be higher on average in October and November, as that's when we've seen some big swings historically. Now let's take a look at how the storm warning has changed over time. And we got a chart here of the VIX going back to the beginning of the year. So this is year to date, and we're putting on a 50-day moving average as well. That is showing up in blue. This smooths the VIX's choppy and spiky price patterns. And you can see that big spike around Liberation Day in early April, earlier in the year, and recently we had a spike in mid-October. That was a China tariff scare. Now the current spike just got a little bit bigger than that, but not nearly the size of that April spike. So we're only expecting some squalls now, not a hurricane, though that can change quickly, just like the weather. Now look at that 50-day moving average and how it formed a sort of ceiling for the VIX after it calmed down in May. The VIX started using that average as a floor. That was a signal that the market patterns were changing, and we might expect more storms than usual, even on days and weeks when the sun pops out. So now let's talk options expiration, or OpEx, and we have a handy guide for that right here. These days, we have options expiring every day of the week. But on the third Friday of each month, and that's November, that's the 21st, we have the monthly options expiring. And this is the one that you can see bigger market-wide effects at times because there's a lot of money's worth of options expiring. Now, investors can buy options on indexes like the S&P 500 and individual stocks, plus ETFs and futures, but index options usually settle at the market open on Friday, while the others usually stop trading after the market close. Some of the heavy selling that we saw during the week was due to the buildup of index options around certain prices. But as these bets and hedges roll off on OpEx day and new contracts are written, this can be a sort of reset for the market. Sometimes we also get some quirky activity on options days, but usually the indexes have lower volatility than usual. This happens as big stocks get pinned at certain price levels because of their own options activity. Suffice to say, there's a ton of math involved and options are not for everyone, but it is helpful to know when there's a possibility of a squall forming out of the blue. So how do we use all of this heading into Thanksgiving week? First, we want to watch the market weather patterns and what they actually are. Do daily stock swings start to shrink, or do they stay big? what tells you whether the weather storms are moving out or still rolling through. Then you got to watch the weather forecast. Does the VIX itself ease back down? That suggests that demand for protection is fading. Or does the VIX stay high, which shows that higher demand for protection by Wall Street is there? And by pressing that a little bit further, we can also ask how the VIX is reacting around those recent highs and lows and how it behaves around that 50-day moving average. Is it spending more time above or below it? Because that can tell you when the forecast is changing. It takes a while for the VIX trend to change, probably a little bit longer than a holiday shortened trading week, but if you keep an eye out on the VIX regularly, you'll learn to start some early changes in its behavior. And the good news is, you can do all of this easily with the Yahoo Finance app or website. It's nearly winter, but the bears are not hibernating just yet. They are out playing in the markets, making their presence known. So it's fitting that on today's Stocks in Translation, we are taking a look at short interest. And when we talk about shorting, that just means someone has borrowed a stock from someone who owns it so that they can sell it first, hoping it will decline. And later on, they're going to buy it back, which is also called covering the short. Now, market regulators require bi-monthly reports from brokers that identify shorting activity, and there's a 1 to 2 week delay, but they can still be very useful. And the key statistic to look out for is the short interest. That's the number of shares that investors have borrowed and sold short, and it comes as a percentage of the shares available to trade. Another step that you want to keep track of is the short interest ratio, also called days to cover. Now, we recently sat down with editor-in-chief of Investopedia, Caleb Silver, in an episode of Stocks in Translation, who explained it.
When you look at short interest, you want to look at how many shares are being shorted relative to the overall share count, right? You want to look at what they call the short interest ratio, how many days to cover.
It is a number that tells you how many days it would take, in theory, for all the shorts to buy back and cover their positions. A higher number means a lot of shorts. But on the flip side, it also means there is a higher chance that the shorts get caught in a squeeze. More on that in a minute. For now, let's take a look at the Wi-Fi Interactive here. And I got all of these stocks, by the way, using the Yahoo Finance short screener on our website, also available on our app. And here I decided to only look at the top 20 companies that had at least $100 million in market cap, so nothing too small. One of the stocks Caleb was looking at is Jack in the Box, and we can see that right here. And Caleb had this to say.
So that's a stock that investors have been betting against, which makes me sad because my grandfather used to take me to Jack in the Box when we were running errands around Southern California back in the 70s.
Personal feelings aside, it's worthwhile going over some of the stats on our site. Turns out there are nearly 5 million shares sold short in Jack, and that number is up about 500,000 from the prior month. And to put all this in context, that means over 1/3 of the tradable shares are currently sold short. That translates to nearly 4 days to cover all those shorts based on recent trading volumes. So it's not surprising that Jack is down about 65% this year alone. Now here's Caleb weighing in on the bear case, also the bull case.
If you looked into the fundamentals of Jack in the Box, not great right now either, but the fact that there's so much pessimism around it, it's a good flag for retail investors whenever they're considering buying a single stock.
And as Caleb notes, even if you're a bull, it can really help to get up to speed on the short interest stats, because that can be the fuel for the next leg up, what we call a short squeeze. And here's Caleb one more time, recollecting the GameStop and Reddit surge that we saw in the early pandemic.
Can I bring you back a few years to 2021?
Yeah,
that
the
was the
GameStop
game,
phenomenon.
right? The more the short interest, the more that big institutions and hedge funds were betting against these stocks, the more that retail investors, especially in meme stock land, were squeezing these stocks by buying them and encouraging others to buy them, setting the price higher, and that makes the people that owned it, that were shorting it, have to pay up those shares that they borrowed.
And buy they did, in what would be a recurring theme for years. So here we have a quick recap on how you can use short steps. For the bear case, high short interest can flag trouble. Sometimes you'll even see short interest climb before bad news becomes public, so it's very useful information. And heavy short interest can also signal an end to a rally, but there's no magic formula. Stocks can rally for long periods amid growing short interest, which brings up the bull case here, because all those shorts can be fuel for rallies, and shrinking short interest can help confirm turns, with a delay, of course, of about 1 week or two. Now, there's always nuance here, but check out the Yahoo Finance short screener and start keeping an eye on how some of the most heavily shorted stocks are performing under different market conditions. And before you know it, you'll start noticing some tradable patterns. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.